Hi, and welcome to part two in my two-part series of RMDs, or required minimum distributions. In the first part, I had discussed what an RMD is and why it exists. In this video, I'm going to discuss how it works, how it's calculated, and how it's calculated differently for different situations, and also what types of accounts to consider. Now, this is intended to be a general educational two-part series, not specifics, and I don't want to get too far into that because the laws change every year, and I would rather have this be a little bit more timeless in that regard. So, how do you do it? How do you figure out what you have to take out? Well, this is about the 10th time I've tried this section of the video, and it's gotten so complicated, I'm just going to break it down to some of the basics. Remember in the first video I had said that you had a total you have to figure by December 31st of the prior year, and then divide that by a number based on your age. Keep in mind that if you have more than one account, one of the same type, you can all bunch those all together. Like, for example, let's say you have 3 IRAs, and you can add that total together, take the money out once you figured out what it is, out of any one of them or some of each. It doesn't have to be every single one has to come out. If you have an IRA and a 401k, for example, two different types of accounts, now you've got two different calculations. You can't lump them together. You got to do it separately. There are other rules that if you're still working and you have a plan at work and you're in your 70s, maybe you don't have to draw from that account. If you inherited a Roth IRA from someone that's in their 70s, it's another thing for you to have to consider. And finally, if you're charitably inclined, but you have to take money out, but you really don't need it, keep in mind that there are rules at this point in time that allow you to gift directly from your retirement account to a qualified charitable institution and avoid any income tax on that gift. And hopefully this will help you understand some of the basics and also make you realize that you probably are going to want a little bit of help either with your own financial professional, tax consultant, accountant, to make sure you're doing the right calculation at the right age for the right amount from the right account. So to sum it up, if you have money that's never been taxed, the government doesn't want you to keep it forever without getting their hands on the tax dollars. Depending on how many accounts you have, if they're of the same type, if you're married and your spouse is much younger than you, if you've inherited an account from someone that's already starting to draw that money out, and or if you want to give money to charity. All of these are things to consider within the RMD rules. So I hope that did give you a little bit of a general sense about how important it is to do the right calculations and an idea of why this was created, why these rules were created and what they're for. And of course, if you have any questions, feel free to reach out to me. Thank you. Hey, thanks again. And if you're interested in more content, fun financial facts, or other videos, just go to your browser and type #JimRobinson on point.